The U.S. market is currently closed. At the closing bell on Wednesday, October 22, 2025, Rezolve AI PLC, ticker RZLV, finished the session at $4.32 per share. That was a significant drop, down $0.34 or 7.30% for the day. Now, the first thing an investor sees is that 7.3% drop and assumes a panic. But the immediate, unexpected reality is that this drop happened on volume of just under 20 million shares. That sounds like a lot, but Rezolve's 30-day average volume is over 28 million. This wasn't a mass exodus. It wasn't a market-wide stampede for the exits. This was a calculated, heavy-handed sell-off, and it coincides with something far more concerning than a simple bad trading day, a sudden barrage of announcements from major investor rights law firms, Rosen, Pomerantz, Schall, all declaring investigations into potential securities claims on behalf of Rezolve shareholders. That is the reality hitting the tape, and it completely changes the narrative. The expectation for a stock like this, especially one that just came onto the public markets, is pure, unadulterated growth. You see AI in the name, you hear about their partnerships, and you immediately start comparing it to the meteoric rise of Nvidia stock or the platform dominance of Apple stock. The expectation is that this is a simple, high-growth AI play for the e-commerce world. But the reality is that RZLV is proving to be one of the most volatile and complex stories on the market today. The tension is palpable. On one hand, you have the company's official narrative, which is incredibly compelling. Just a few weeks ago, on October 1st, Rezolve released its first half 2025 results. The numbers looked fantastic. They reported H1 revenue of $6.3 million, a staggering 426% increase year over year, which beat analyst consensus. They reported an almost unbelievable gross margin of 95.8%. They announced they have over 100 enterprise customers, including massive names like Ferrero, H&M, and Urban Outfitters. Best of all, they raised their guidance. They are guiding for a 2025 exit rate of at least $150 million in annual recurring revenue and initiating 2026 guidance for a $500 million ARR exit rate. This is the story. This is the expectation. It's the kind of story that gets investors on Robinhood and SoFi Invest excited, looking for that next 10-bagger. They see a company partnered with Microsoft and Google pushing a new concept called Agentic Commerce with its own proprietary AI model, Brainpowa, which it claims is competitive with GPT-4 but with zero hallucinations. It sounds like the perfect investment. Then you have the market's reaction, the reality. The stock is down over 20% in the last 5 days and over 32% in the last month. Yesterday's 7.3% drop is just the latest blow. Why? Because the market is digging deeper than the headlines, and it's finding contradictions. That glowing H1 revenue beat of $6.3 million was great, but other reports focusing on the quarterly number for Q2 noted a significant miss against forecasts. One analysis pointed to Q2 revenue coming in at $4.88 million, 27.7% below the $6.75 million that was expected. So now you have a conflict. The company is cheering the half-year growth while the market is punishing the quarterly miss. This is the kind of discrepancy that makes institutional money, the kind managed by Fidelity Wealth Management or traded through Interactive Brokers, extremely nervous. And it's almost certainly what triggered that string of legal investigations. The lawyers are asking, is the company painting a picture of $500 million ARR while fumbling its current quarterly revenue? That's the multi-million-dollar question. Let's look at the technicals and the flow. This is not a stock for a passive Schwab Intelligent Portfolios account. This is not a set-it-and-forget-it intelligent portfolio. The 52-week range is $1.07 on the low end and $8.45 on the high end. The historical volatility is astronomical. This is a battleground stock. What's fascinating is who is doing the fighting. While retail might be getting shaken out by this 30% drop, the institutional filings tell a different story. In September, the company announced that institutional ownership had crossed 10%. And these aren't small names. We're talking about Citadel, BlackRock, Vanguard, and Jane Street all taking new positions. This means that while the Robinhood app user might be panic selling their Robinhood fractional shares, the largest funds in the world, the ones that power Fidelity mutual funds and major Fidelity ETFs, are quietly buying. They are making a calculated bet. This suggests the smart money is looking past the current legal noise and the quarterly revenue miss, and they are focused entirely on that $150 million and $500 million ARR guidance. They are playing a different game. So what does Rezolve AI actually do to command this kind of attention? It's crucial to understand they are not the Rezolve.ai that handles IT service desks for Microsoft Teams. That's a different, similarly named private company. RZLV, the public company, is focused squarely on e-commerce. Their main product is the Brain Suite. This is an AI platform that retailers like H&M plug into their websites and apps. It powers conversational commerce, letting you talk to an AI to find a product, brain checkout, streamlining the payment process, and advanced visual search. They are essentially selling a high-margin AI upgrade to the world's biggest retailers. They make their revenue primarily through subscription-based models, SaaS, which is why their gross margins are a sky-high 95.8%. They aren't selling widgets, they are leasing a digital brain. This business model is the core of the bull case. It's built for scale. The company's argument, and presumably the argument that convinced Fidelity and Citadel, is that the stock is absurdly undervalued if you believe the ARR targets. The company itself has pointed out that while it trades at roughly 17 times its forward ARR, AI peers like Anthropic are valued at over 36 times, and Sierra AI is at 100 times. Their expectation is that the market will wake up and reprice RZLV to match its peers. But the reality is that it's not being priced like its peers right now. It's being priced like a company with a serious credibility problem. The market isn't just looking at ARR, it's looking at the cash burn. The company posted an adjusted EBITDA loss of $17.7 million in the first half. Now, the good news is they are well capitalized. After recent financing, they have about $230 million in cash. Their own target is to reach profitability by the first half of 2025. That $230 million gives them a runway, but it's not infinite. And this is where the investment help comes in. You have to understand the risk. The bear case is simple. The Q2 revenue miss wasn't a blip, it was a sign of a struggling sales cycle. During the last earnings call, management admitted there's a 7 to 9 month lag between signing a customer for ARR and that ARR turning into recognized revenue. The bears are betting that the company will burn through its $230 million before that $500 million ARR fully materializes, forcing them to raise more capital at lower prices. And they are betting that these class action lawsuits will uncover real problems, scaring off the enterprise clients they need to invest online in their platform. This is a classic high-stakes story. It's not a safe haven stock like a blue chip. It's not even a momentum play like Tesla stock was for years. This is a binary bet on management's ability to execute and convert their impressive customer list into actual recognized revenue, and to do it before the market loses patience or the lawyers find a smoking gun. For someone doing self-investing through a Fidelity brokerage or SoFi investing account, the choice is stark. You are either betting with Citadel that this is a 100% upside opportunity based on analyst targets of $9 per share, or you are agreeing with the short-term market that the 7.3% drop is just the beginning. The platform you use, whether it's the Fidelity mobile app or the Advanced Interactive Brokers platform, doesn't change the underlying risk. Online investment has made it easy to buy SoFi stocks or SoFi ETFs, but it hasn't made the due diligence any less important. This is not a stock for your Fidelity IRAs or a SoFi robo-advisor. This is an SoFi active investing play, or more accurately, a speculation. Speaking of those big enterprise clients, that's a key part of this puzzle. Comment below if you think enterprise customers like H&M and Ferrero will stick with Rezolve AI through this volatility, or if this legal noise and the stock's performance will scare them off from renewing their contracts. That is a massive, unquantifiable risk. So, as we look to the future, the